Hello everyone. We hear that bond markets are under pressure, but what about default rates? So we all have been abruptly reminded that bonds are not always following a smooth path. While for a majority of bonds, volatility is just a bad moment to pass while waiting for maturity, for some of them, it can lead to the ultimate bond risk. Default. The May Moody's report on defaults reveals some interesting information. Reassuring in the first place, since the default rate for high-yield debt, even if it's slowly increasing, is only at 2.1%. In the US, for example, the independent power producer Talen Energy Supply was caught in the middle of rising gas prices, low margins, high debt, limited access to liquidity, and consequently rising collateral requirements. In emerging markets, Chinese property developers continue to suffer with 2 new defaults in May. Market conditions remain complicated and access to capital extremely limited. This has led Goldman Sachs to raise its default forecast for the sector to almost 32%, or nearly 1 in 3 developers. Given that the construction sector has been the worst this year with 9 defaults, it is fair to assume that it may not stop there. Russian issuers may also be adding to the statistics soon, as the grace period for Russia ends on June 26. Although in this case, the heart of the problem is more political than economic, as Moscow believes it is being pushed into default. And if this happens, it will be the first Russian default on foreign debt for a century. So what are the prospects? In its most pessimistic version, Moody's estimate that the high-yield default rate could rise to 10% by May 2023. The central scenario is, however, less dramatic, 3.3% next May, which is below the 4.1% annual average. A significant number of indicators have turned orange, but Moody's also notes that liquidity needs remain rather modest, as many companies have already refinanced. Besides choosing issuers with strong cash reserve, what should an investor look for? Firstly, if they wish to venture into high yield, the approach through collective vehicles such as investment funds is highly recommended, as they will benefit from a significant diversification effect. And then remember that the interest rate risk remains high in the current phase of rising yields, and it is advisable to favor short maturities. And finally, remember that in certain market phases, having the objective of not losing money is a more than honorable ambition. Thank you.